Good morning. This is the KINOP morning news for Thursday, July 16, 2026. I am DJ Bori, and today we are starting with a market that still likes risk, but is no longer willing to ignore interest rates, the dollar, and earnings quality. The first idea for the morning is simple. Artificial intelligence and semiconductors remain the center of the market story. Data centers, high bandwidth memory, cloud capital expenditure, power equipment, and cooling infrastructure still form one connected investment cycle. But a strong story does not mean every price is reasonable. The more a sector rises, the more carefully investors have to ask whether the next earnings report can support the move. In the United States, large technology shares have continued to carry much of the long-term narrative. Investors are watching server demand, advanced chips, and the spending plans of the major cloud companies. At the same time, the market is splitting winners from passengers. Companies with visible revenue, margin strength, and the real order flow can hold up better. Companies that moved mostly on hope can react sharply to even a small move. Inchi bond yields. Rates are still the key speed limit. Investors like the idea of future rate cuts, but central banks still want to see inflation and employment data clearly. If growth is too strong, the timing of rate cuts can move later. If growth is too weak, the earnings outlook can weaken. That is why good economic news does not always become good stock market news. Into this phase, Treasury yields, the dollar, and the Korean won should be read together. For Korean investors, the $1 exchange rate is a direct market temperature gauge. A steadier won can help foreign flows and reduce import cost pressure. A stronger dollar can slow the KOSPI, especially in key sectors where foreign trading is heavy. During the session, do not watch only the index level. Watch foreign futures flow, large cap turnover, and whether the currency is confirming or resisting the equity move. In Korea, semiconductors remain the first sector to check. High bandwidth memory, server DRAM, and AI supply chains still have a solid medium-term story. But even inside semiconductors, not every stock deserves the same treatment. Investors should check whether price increases, shipments, customer investment plans, and inventory normalization are showing up in key actual numbers. In a strong mood, numbers matter even more. Power equipment is another important area. Data centers need electricity, cooling, networks, and reliable infrastructure. Transformers, cables, switchgear, and cooling suppliers can all benefit from this cycle. But this is not only a theme. Orders, delivery schedules, raw material costs, and margins have to move together. A large order book is useful only when it becomes profitable revenue. Shipbuilding and defense should be viewed through a longer order cycle lens. Shipbuilders need favorable vessel prices, currency support, and cost control. Defense companies need export contracts, delivery schedules, and margin visibility. Both sectors have strong narratives, but a strong narrative can already be reflected in chip price. Today, the safer question is not what the next headline might be. The safer question is how fast existing orders become sales and profit. Battery and electric vehicle names still need selection. EV demand is recovering unevenly by region, and battery material costs are not fully settled. A rebound can happen, but investors should separate a structural recovery from a technical bounce after a large decline. Priority belongs to names where trading value improves together with earnings estimates. Financial shares can work as a defensive check on the market. When rates do not fall too quickly, banks and insurers can show earnings stability. But if slowdown worries rise, credit costs can return to the conversation. Dividends and buybacks are helpful, but the rally needs earnings quality and clear capital policy to continue. Consumer names require a more careful approach. When household costs remain high, pricing power becomes more important than simple sales growth. Cosmetics, food, retail, and entertainment should be checked for overseas sales, brand power, inventory discipline, and margin control. A broad consumption recovery is useful only when it appears in the actual unit economics. Real estate and construction cannot be judged only by hopes for lower rates. Some local transaction recovery does not automatically mean a full market recovery. Unsold inventory, project financing pressure, and construction costs remain important. For builders, cash flow and order quality matter more than a simple rate cut story. Crypto remains a quick thermometer for risk appetite. If Bitcoin holds key levels and trading value remains firm, personal investor sentiment is still alive. But if altcoins cannot participate broadly, it is harder to call the move aggressive new risk taking. Today, watch trading value, volatility, and the relationship between crypto and US technology shares. Here is the checklist for today. First, respect the leading stocks, but write down why they are leading. Second, read the index together with the $1 rate and bond yields. Third, when earnings dates are close, trust numbers more than expectations. Fourth, inch crowded sectors use a reference price instead of chasing. Fifth, do not buy laggards only because they look cheap. Wait for evidence that the structure is improving. The conclusion for Thursday, July 16 is balance. This is not a market to avoid completely, and it is not a market to attack without discipline. The AI and semiconductor cycle is still alive, but rates and currency can continue to limit speed. Respect the leaders, control the entry price, and check whether quieter names still have a real structure behind them. Thank you for listening to KINOPOD Morning News. Have a calm and steady Thursday.